So I think one has to look at, maybe the sources of this liquidity. And I think it's, a question of saying that maybe if one puts it very crudely or maybe very simplistically to say that the Federal Reserve controls the valuation of the market, in other words, the PE multiple. That's largely the result of what the Federal Reserve does. But then the E is something different. It's much more the People's Bank of China because of China's large footprint in the world economy. China can control world GDP growth, and it does, and as you cited, commodity prices. And that has a very big bearing on the E that a lot of corporations around the world get, their earnings number. So you've got the two central banks that are essentially neatly dividing up the pie. One is looking at valuation, one is looking at earnings. And what we've had for much of the last 12 months or so is that both of those central banks have been tightening, the Federal Reserve pulling down valuations on markets, and China crimping liquidity and adversely affecting the E in the earnings number. So you've had low economic activity and you've had depressed valuations. What we would hope is that in 2023, we see a reversal, maybe first from the People's Bank of China, injecting liquidity to try and get the Chinese economy restarted after this damaging lockdown, and then ultimately from the Federal Reserve as they begin to win the battle against inflation, and they can start to push more liquidity back into markets. Now, it may be, and I suggest I throw this out as a sort of bone to the bulls, is that what you may be seeing right now is that the Federal Reserve is beginning the process of switching away from QT, quantitative tightening, towards a QE, a quantitative easing process. And it's not because they feel the economy deserves it yet, but it's much more for financial stability reasons. And the shift towards financial stability focus has really been driven by what happened in the UK gilt market in September after the, let's say, very poorly presented trust budget. The gilt market sold off, as we know. Sterling took a major hit. But the key point to note here is that for central banks or policymakers globally, what really spooks and unsettles them are problems in the sovereign debt markets, because that's the heart of the financial system. And what you saw in the UK gilt market was unprecedented. Gilt prices, in other words, government bond prices, fell precipitously, yields spiked up. That would have been a major hit to the cost of servicing government debt in the medium term if it persisted. It would have derailed UK fiscal plans tremendously. And that is a wake-up call for central bankers worldwide. And I would suggest that lesson has been learned. If it has not yet been learned by the Bank of England, it's been learned by the Federal Reserve. And so the Federal Reserve is, in our view, is beginning to make this division now between monetary policy for economic cycle reasons and monetary policy for financial stability reasons. And it's the financial stability reasons which are coming to the fore now, because what you have in the US markets is maybe a similar lack of headroom in terms of liquidity available for the US Treasury market. And the US Treasury market is the most important financial market worldwide. So as we speak, we may be seeing the very first signs of the Federal Reserve beginning to crack here.